Why do smart people keep losing fortunes when markets crash? And how can something as simple as tulips or as groundbreaking as technology trigger economic meltdowns? And why can't we seem to stop history from repeating itself? Today, we're unraveling economic bubbles and crashes, how they happen, why they happen, and what we can learn from them. Welcome to Unravel, Money and Economics. In this channel, we simplify the world of finance, economics, and money, so you can understand how it all works no matter your background. Let's start at the core. What exactly is an economic bubble? Simply put, a bubble happens when the price of an asset, like real estate, stocks, or even digital currency, rises rapidly beyond what it's actually worth. Prices inflate far above their fundamental value, driven by hype and speculation, not facts and figures. The story always begins the same way, with excitement. Maybe it's a revolutionary new technology, easy credit, or an exciting investment opportunity that promises incredible returns. Early investors see genuine growth potential. Prices start rising. And here's where psychology kicks in. Humans are emotional creatures. When we see others making money, we want in. It's fear of missing out, FOMO, that turns cautious optimism into frantic speculation. More people buy in, prices surge higher, and soon, logic takes a back seat. Everyone assumes prices will keep rising. But beneath the surface, reality tells another story. Eventually, the disconnect between price and true value becomes unsustainable. When that happens, all it takes is a tiny trigger. One piece of bad news, a small rise in interest rates, or even a shift in investor confidence to burst the bubble. Suddenly, panic sets in. Prices crash, investors rush to sell, and fortunes evaporate overnight. This cycle has played out repeatedly throughout history. Let's dive deeper into some famous examples. Take Tulip Mania in the 17th century Netherlands, often called the world's first recorded financial bubble. At its peak, a single tulip bulb cost more than a luxury home. Speculators thought prices would never fall, but they did. Spectacularly. Within weeks, bulbs lost nearly all their value, devastating countless investors. Or consider the infamous dot-com bubble of the late 1990s. The internet revolution promised unimaginable opportunities. Investors poured money into startups with little more than catchy domain names. Profits didn't matter. Only growth did. By early 2000, reality hit. Companies with no business models collapsed, stock prices plummeted, and trillions vanished. Many investors lost everything. Then there was the 2008 housing bubble. Cheap mortgages, easy lending standards, and speculation sent home prices soaring. Investors believed real estate prices couldn't fall. When interest rates rose and defaults began, the bubble burst spectacularly, triggering the global financial crisis. Job losses and economic turmoil felt worldwide. But bubbles aren't just historical artifacts. Recently, we've seen speculation in cryptocurrencies like Bitcoin and Dogecoin. Digital assets surged dramatically, sometimes thousands of % in mere months, before falling sharply again. Each bubble is unique, yet all share striking similarities. But why do we keep falling into the same trap? It's about human behavior, specifically cognitive biases. There's herd mentality. We naturally follow the crowd, assuming collective decisions must be safe. Then there's confirmation bias. We see only evidence that supports our optimistic beliefs, ignoring warnings. And of course, overconfidence, the belief that we know better and can get out before others. These biases aren't flaws. They're built into human psychology. Unfortunately, they cloud our judgment precisely when clarity is needed most. Can anything be done to prevent bubbles? The reality is complicated. Economists, regulators, and governments constantly watch markets for signs of bubbles. They track metrics like debt levels, valuation ratios, investor sentiment, and excessive speculation. But spotting a bubble isn't enough. It's knowing when to act. Intervening too early risks halting genuine innovation. Acting too late guarantees disaster. Central banks often raise interest rates to cool speculation, while regulators implement rules to limit risky investments. Yet, these measures aren't foolproof. Markets evolve rapidly, often outpacing regulations. That's why education is crucial. When investors, like you, understand the warning signs, you're less likely to fall victim to market hysteria. So, what exactly should you watch for? First, look for prices that soar far beyond what seems reasonable with little supporting evidence. Second, beware when everyone, from neighbors to news channels, insists that this time is different. Finally, watch for excessive borrowing. When investors rely heavily on debt to fuel their purchases, even small downturns can trigger catastrophic sell-offs. Awareness can be your best defense. But here's a tricky question. If bubbles are predictable, why can't we avoid them entirely? Partly because predicting exact timing is nearly impossible. While economists see warning signs, no one can pinpoint exactly when enthusiasm will flip to panic. Also, bubbles can initially appear rational. New technologies and opportunities genuinely create value. Separating genuine innovation from irrational exuberance isn't always clear-cut. Consider the internet. Despite the dot-com crash, many survivors, like Amazon and Google, became massively successful. Initial enthusiasm wasn't completely misplaced, just wildly exaggerated. That's why bubbles continue. They're driven by optimism rooted in genuine potential. So, how do we protect ourselves? The key is diversification. Don't chase hot trends. Instead, spread your investments across various assets to limit exposure to any single bubble. Always question hype, scrutinize fundamentals, and remain cautious when others become euphoric. Because while innovation creates genuine opportunities, irrational speculation rarely ends well. Here's the bottom line. Economic bubbles and crashes aren't just historical curiosities. They're part of market reality. Understanding them is vital not only for your investments, but also for navigating an unpredictable economic world. Markets boom and markets bust, but informed investors don't have to ride the roller coaster blindly. Recognizing patterns, managing emotions, and making thoughtful decisions can help you weather financial storms. Have a topic you're curious about? Let us know in the comments, and hit subscribe so you don't miss what's next. As we continue to unravel the world of money and economics, one concept at a time.